Calgary's benchmark prices went up for 6 months in a row this year. In July, it went down, the first month to do that. And it happened in a month where there were lesser homes for sale and even fewer people listing them. So, even though the market technically got tighter with supply, it still loosened up. In this video, I'm going to show you exactly what that means because it changes the story from too many homes to something that is actually harder to fix. And at the same time, we are also going to take a look at our predictions from last month's market update because 2 of them ended up being wrong, almost expected. I had low confidence in those actually coming true, but 2 other predictions were spot on, and we are going to check them out and what that actually means for you, either as a buyer or seller in this market. Taking a look at the overall numbers for this month, as you can see, we have 1,904 sales, which is down 9.16% year over year and down month over month by 13.34%. The benchmark price is 569,000, which is down 2%, and this is the new part, which is down 0.58% from June. So that is the first time in this year that the benchmark price has corrected in that month. And it's kind of expected with the change of seasonal data. Months of supply rose to 3.48 and the days of market has gone to 40. And new listings came in at 3,323, which is down 15%, the biggest pullback in listings that we've seen this whole year. Let's see how things look like when you split it by property type across the city. Detached sales is down 1.65% to about 1,112 sales. And the months of supply is down to 2.9, down 3.01%. Semi-detached is the only segment where sales is up at 5.88%, and its price is essentially unchanged from last year, with just minus 0.3% down year over year. Then you go to row, which is down almost 23% year over year, and our supply is up 21% year over year. And taking a look at apartments, we are down nearly 20% in sales with 4.9 months of supply, a buyer's market. So this is the same city, same month, but you can see a complete split in the market, how different property segments are behaving. Let's start with the city as a whole because the one number that everyone will quote is the one that's most misleading. Here's the whole month on one screen. If you notice the sales to new listings ratio column right here, you can take a look at the detached is at 59%, so it's almost 60%. Semi-detached is at 62% this month, whereas the row is at 56% and apartment is at 51%. Now, those look healthy, and that's the trap that I'm going to come back to explain what is really going on. On the far right, you can see that every single one of the benchmark prices is actually down year over year. Detached is down 1.87%, semi is down 0.3%, row is down 6.1%, and apartment is down by 8.37%. So all 4 out of 4 benchmark prices are down. Remember that when we actually get to looking at the average price. Taking a look at just the benchmark prices and how they compare to each other in relationship with the scale, you can see here detached 749, semi-detached 691, and look at that year over year minus 0.3%. So semis are basically flat. Total residential 569, 2. Row is 418.5, down 6%. Apartment 297, so down 6%. And now if we take a look at the month over month column on the right side here, you can see every one of those is also negative. That has not happened even once in 2026 until this month. So every single one of them fell in July, the first time in 2026. Now here's the headline that you might see everywhere for this month that says the average Calgary home price actually went up by 2%. That number is real. It is also completely misleading, and here is why. On the left, every single property type is worth less than it was last July. Whereas on the right, detached went from 49% as far as market share goes to 53%. Apartments went from 24 down to 21%. So when the cheap part of the market stops transacting, the average price of what's left goes up. So even though nothing actually became more valuable, that's not appreciation. That's just simple math. The market just moves to other segments of the market, and that's why the average price went up. Now to highlight the clear divergence that is happening in the market, Detached 1,012 sales. So it's essentially down 1.65%, mostly flat. Whereas 2.9 months of supply, which is tighter than last July. And 33 days on market, down from 34. So if you take a look at the same numbers for the apartments at 408 sales, which is down 20% year over year. 4.9 months of supply, so very clear buyer's market. 54 days up on market compared to last year, which was at 45. And Detached is the only segment in the entire city where the homes have actually sold faster this year than the last year. So apartments took 9 days longer than last year. So in a month where everything almost got worse, Detached has actually quietly been getting better. Now let's pull the city-wide numbers because this is where they stop being useful. Find your exact district in the next 4 slides to know what you should be looking out for. First, taking a look at Detached by different districts. So you can see West is the tightest detached market right here at 1.96 months of supply. And prices are up year over year by 2.31%. At the same time, Northeast is a buyer's market at 5.11 months of supply with prices down at 6%. So that's a slight improvement over what we've seen for Northeast towards the start of this year. That is a 2.6 supply gap though inside that one property type between West and Northeast. Taking a look at semi-detached by district, you can see here for Southeast, the semi is actually at 1.7 months of supply. So that's the tightest part of the market with 84.62% sales to new listings ratio. So properties are moving fast when it comes to semi-detached in the Southeast. And that is the tightest sell in the entire data set here. West is the only district where prices have actually gone up. And 6 out of 8 districts have had sales under 30. So they are just directional data only. Checking out row townhomes, you can see North and Northeast rows are actually in oversupply at 5.91 and 5.59 months, looser than most apartment districts. So Northwest is the most resilient at minus 2.56%, and East has actually fallen by 4.98 in one single month right here. But remember, that is only based on 10 sales, so take it with a grain of salt. Finally, taking a look at apartments across all districts, you can see they declined all the way from minus 7.22% in the Northwest to minus 13.83% in the East. City Center alone holds 872 of this inventory units. That is 43.6% of every apartment listing in Calgary. And they sit at about 5.42 months of supply. So you have a lot of options in the city center if you're looking to purchase an apartment there. And if you're looking to sell an apartment, you're probably going to have the hardest time in city center, depending on what your competition around you looks like. Now, finally, looking at the months of supply by segment and district, you can see every bar past the 4-point line is buyer's market. So everything past here is a buyer's market, and everything below the 2.5 is a seller's market. So if you look at Northeast, 3 of its 4 bars right here are all in buyer's market. In fact, I would argue even the semi is actually a little past that point. Now, if you look at the West, the detached bar is actually under 2. So that is a very, very tight seller's market. The citywide number for Calgary is 3.48, which sounds perfectly balanced, but in reality, it describes very few of these bars, as a lot of them are still in strong seller's market, and that is the reality that hits a lot of buyers when they actually get out into the market and are surprised by how the market reacts to the offers they put in. So it is very important to understand where on these bar graphs you lie and how much leverage you actually have as a buyer or seller in this market. Now, taking a look at one of my favorite charts, and this isn't direct prep data. This is actually my own database of actual sold transactions in Calgary, and it maps every property in every district essentially on two axes. How long it took to sell and what share of it sold above asking price. So this is based on the last 90 days of sales, so May through the start of August. Top left is the buyer leverage, whereas the bottom right is seller leverage. Now, if you look at the apartments, they all sit almost at this top left area. So the apartments is this bright blue, and you can see all of them clustered around here. And at the same time, Northeast apartments actually took a median of 43 days to sell, and just 2% of them sold above asking. Now, if you look at Detached in the West, right here, they are sitting at the bottom right, 15 to 19 days, with a roughly a quarter of sales going above list price. That's more than 25%. So two completely different negotiating positions for the exact same city over that 90-day period. So based on which district you're in and which property type you have, this will tell you really how much leverage you have in the current market. And even though this is a completely different source of data, it tells you the exact same truth that we got from analyzing the Calgary Real Estate Board. This next section is the reason I read all 29 pages instead of just the press release that Calgary Real Estate Board puts out. 3 things in this month's data that headlines generally will completely miss. Calgary doesn't really just happen in a vacuum. 2 national charts that explain most of what you just saw. On the left is the inventory surge that defined the past 2 years is over. Construction is significantly slowing down and supply is tightening. So builders are reacting to the change in demand. And on the right, the population growth that fed the housing demand has also fallen hard. So Calgary Real Estate Board's own chief economist actually named it as a sudden drop in mostly international migration on top of years of high construction. That's the whole mechanism. Few new households are forming, while 17,000 apartment units are still under construction in the city. This is the number that changed my read on the market. New listings are down 15% year over year, and your inventory is down by 4.23%. So we have actually 293 fewer sales than there were last July, and months of supply went up in the same time. So that combination should generally never happen. If there is less for sale and the market gets looser, then the shortage isn't really homes. The shortage is buyers. So now if you look at this table on the right, because citywide numbers generally will hide something, sales fell faster than inventory in row and apartments. Row sales are down 23% against the inventory, which is down just under 7. And apartments down 20 against the inventory, which is down just under 5. But detached and semi went the other way. In detached, supply shrank faster than sales did. So those 2 segments are still tightening while the other 2 loosened up. And the strip along the bottom right here is the inventory against the same month last year. So all of 2026 against last year. And you can see that January we were up by almost 20%. We had 20% more inventory than we did last year. So we were in excess when we were in Jan. But since then, we've had a consistent trend line heading down towards 0 and crossing into the negative. So by May, it's just basically flat. And then in June, we went to negative. And in July, we are down 4.23%. So that's 7 straight months of the same direction. And so this isn't just a July story. This has been building up all year, and I've been calling it out in my market reports. So even though inventory is going down, we expected some level of demand to sustain, even though the season was technically over for spring market. But as you'll see in the predictions, things didn't quite work out that way. And because of that, you have significant loosening happening in the market. But again, looking at these numbers, you can tell it is strictly on the row and apartment side, and detached and semi are actually tightening in the same time. Now, everyone will tell you that the condo market fell apart, apartment sales are down almost 20%. So that sounds right. But look where the loss has actually been. Condo sales under $250,000 actually went up by 53%. Sales above 250 went down 36%. So buyers didn't just leave the condo market, they moved around inside it. That's a repricing and not a complete freeze on that segment. And the chart underneath is from my own Soul database. The median condo buyer has been getting about $10,000 off the asking price since late last year. And if you notice, that line has flattened out. So it has stopped getting worse, which is very, very interesting to keep note of. So yes, there's more room to negotiate everywhere in this market, but there is twice as much room in condos. Now let's rank the calls that we made last month. I made 4 specific checkable predictions about this report, and here's how they scored. I said we'd see the first year-over-year sales gain of 2026. That came in wrong because sales actually came down 9.1%, and the gap actually got wider. I did say inventory would fall below last July again, and that was right. So I expected, because we started on a late spring market, that some of the pent-up demand would continue in. It seems like they found their ways to only specific segments. So yes, sales technically did improve somewhere, but across the entire market, we didn't manage to nail that prediction. But when it came to inventory, that trend seems to be continuing, and that's now 7 months in a row. Taking a look at prediction number 3, I said city center detached would cross $1 million because we had a first district in Calgary that set records and crossed $1 million. But unfortunately, because prediction 1 didn't sustain, so city center didn't manage to do that. But I do think that the next run up that we have will push city center past that $1 million range. So it's just going to be delayed instead of happening this month. And I said that apartment prices would keep falling, and that ended up being right too. So down 8.73%. So 2 out of the 4 predictions were correct. And now here's the part that actually matters, because both of the ones that I got right were about supply, whereas both of the ones that I got wrong were about demand. And that's not just a surprise, because that's the market telling me which half of the thesis was actually broken. Because expecting the spring market to persist this year longer was probably the wrong call, even though they started late. Now I do expect, based on the conversations I'm seeing, there is definitely pent-up demand, but people are taking the sidelines rather than jumping into this market, and it will result in activity sometime later this year. All right, so that's what the data says, and here's what you should actually do with it based on whether you're buying or selling this year. If you're buying, here's where the leverage actually is. Northeast and East apartments are down over 13%, with 5 to 6.5 months of supply. Row in the North and Northeast is sitting at about 6 months. And here's one of the things that most people miss. Detached in the Northeast is at 5.1 months of supply, which is a buyer's market territory inside the segment that everybody calls balanced. So where you will not have leverage is West Detached, which is at under 2 months with prices up, and Southeast Semi is at about 1.7 months of supply, the tightest corner of this entire city. So one caution that I would give you is a falling price in a segment with 5 months of supply is still not a floor. Check the builder inventory before you assume that resale discount is real. And if you're selling, the segment you're in matters more than the district. So detached at 2.9 months is the closest to balanced, price at or just under the last comparable, and a good home still moves. Semi-detached is generally the strongest position in the city right now. Sales are up at about 6%, and the price is flat on the year. Row is the only one you have to be careful with because 3 consecutive months of falling sales and supply up 20%. Prices ahead of that market, not at it. So, and apartments sub 250 is where the buyers actually ended up going now. Here's the line I want you to know. Days on market is 40 and rising. And that's happening with 293 fewer homes competing with you than last July. So scarcity isn't going to help you anymore. Right now, it's all coming down to pricing, fewer competitors, and it's still taking longer. So that tells you you should focus on price. So here's what I'm watching for next month. And because I just showed you my scorecard predictions for last month, I'm going to put 5 new calls on the record. So one, does the benchmark fall a second month? And I do think that is definitely going to continue happening. So 2 in a row and the recovery is over for now because we're off season. And then come September or maybe, end September, that's when I'm expecting us to see a slight recovery back in benchmark prices. And then after that, it would balance back out again for the winter time. Number 2, I'm calling that sales are at or below 1887, so about 1900. So the year-over-year gap does not close back inside that 5%. Number 3, I'm calling that months of supply at 3.48 or higher. So if supply keeps shrinking and that number still rises, then it's demand and my whole read for this month is right. Then number 4, and this one cuts against everything I've just told you. So I'm calling that potentially we might see slight deceleration in the apartment price corrections, and that's only because till the new supply from new construction hits the market altogether, we might see a slow decline, especially with that floor holding under sub 250 with that increase in sales, because I am seeing some people come back into the market for purchasing those sub 250 apartment condos. So we might see a small floor forming and then a bit of a sideways movement until we either pick a direction and go. And then number 5, Northeast Detached stays at about 4 months. And I'll score all of these next month, see how we perform. Of course, I don't expect all of these to be right. Some of these are a little bit of a bold call, but we'll figure out where that goes. Detached and semi-detached seem to be holding up pretty well, whereas apartment and row are really working through this market. If you found data like this helpful, make sure to hit that subscribe button so you get updated every single time I put out a video every month. We tear the data apart here on this market report and also go through the data that I collect on my own database. And on the screen, you can also see the QR codes for getting your free guides. So you can check out the community guide and also the market report, all in the description below. And I'll see you guys in the next market report. Till then, take care.